Good afternoon. I'd like to welcome you to the Sheriff's Office Retirement Plan Board meeting this day on Thursday, September 23rd at 1 o'clock in the afternoon. We are in the Chesapeake Building in Leonardtown, Maryland. First on our agenda is a call to order, and so we are all present. I'm Rebecca Bridget, the County Administrator. On my left is John Walters, citizen member, and Lieutenant Moses from the Sheriff's Office. To my right is Lieutenant Safford from the Sheriff's Office, and Catherine Pratson, our Plan Administrator, and Sheila Smith is our Plan Coordinator. Amy Carter is our videographer, and Ms. Cudmore is joining us via Zoom. So all of our board members are present. Number 2 on our agenda is roll call. So we'll have you look at item 2A for the agenda for today's meeting. If you take a minute to review, we'll entertain a motion to approve, please.
Move to approve the agenda as presented.
Thank you. Do we have a second?
I'll second it.
We have a motion and a second to approve today's agenda. Any discussion? Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. And item 2B is our meeting minutes from our last meeting, August 26, 2021. If you take a minute to review, then we'll entertain a motion to approve.
I'll make a motion to approve the meeting minutes for August 26th.
I'll second.
We have a motion and a second to approve the meeting minutes for August 26th. Is there any discussion? Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. And item 2C is the calendar year 2022 Sheriff's Office Retirement Plan meeting schedule. Catherine Pratson, if you'd like to go over that, I will turn the agenda over to you.
Thank you. Thank you, Dr. Bridget. And the schedule is consistent with previous years, with the dates scheduled for the fourth Thursday of the month. The only exception to that is in November. And in previous years, we have had a meeting before Thanksgiving. The proposal this year is to have the meeting after Thanksgiving, which is December 1st.
Any questions for Ms. Pratson? Hearing none, we'll have a motion to approve.
Move to accept.
Is there a second?
I'll second it.
There's a motion to approve the calendar year 2022 SORP meeting agenda. Any discussion? Hearing none, all those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you. Now we move to item 3, which is new business. And first on our agenda is retirement calculations and the DROP program. And I believe Mark Calbaugh from Bolton is on Zoom.
Thank you, Dr. Bridget. And just as a brief introduction, we've had, particularly Lieutenant Safford and Sheila and myself have fielded a number of questions from SORT participants. And we think that perhaps this was a result of Karen's retirement and everybody wanted to make sure we knew what we were doing. But in response, both Lieutenant Moses and Lieutenant Safford sent out the plan document, the plan summary, and drop FAQs to all the participant members. All the members had an opportunity to submit any questions and were made aware of the fact that Mark was going to present a brief overview today for how benefit calculations are determined. And should there be a need for a more detailed presentation and any kind of follow-up, Mark is and happy to do that at a later meeting.
Great, thank you. Any questions from the board before Mark gets started? Okay, take it away, Mark.
Okay, I am joining you through Zoom, and I apologize. I've had camera problems all day today. Can you hear me okay?
Yes, thank you.
Yes.
Okay. So you're just going to hear me and not see me, and it's too bad I look good today. I've dressed up for nothing, it sounds like. So what I'm going to do, and I sent Catherine and Sheila some slides, if you will, and they printed them out. And there should be 5 of them that we could go through together. The first one, so I'm going to walk you through what I see as our calculation process, starting from when we get a request from the county, from your office, the benefits administrator, which used to be Karen Gates, is now Sheila Smith. And she sends us a request through email, and that request contains an Excel sheet that looks like, which should be the first page in your 5-page pile. And just so we're all looking at the same thing, just down from the top after St. Mary's County, it should say capital A basic data.
This one?
Does everyone see that?
Yes.
Yes, and it's up on the screen as well. Thank you.
Okay. And again, I can't see that. Okay, so Sheila will provide us the information for this participant. I've created a Joe sample participant whose data should be fairly realistic. This is the sort of data that Sheila would provide us. Obviously, the name, the date of birth, the date of hire, when the participant is terminating, when the participant is retiring, which means the starts receiving benefits. Generally, participants, but not always, they terminate towards the end of the month, and as soon as administratively possible, payments should begin the first day of the following month. Sometimes that's delayed, especially if the request is made late in the month, but that's not a problem. Just a retroactive payment will be made for any missed month or months where you didn't get a payment. If the participant is married, it provides a spouse date of birth. So by the way, we have a database that we've collected over the years. I've been working on St. Mary's as a client that's when Dee Snyder was there, so it's before '08. So, and that database existed before I started as an actuary working for your plan. We, every year, through the benefit statement process, or the valuation process. Your valuations are every other year, but your benefit statements are every year. Data is provided to us from your office. And once a person is newly hired, we keep that participant's records as long as they're active, and then when they either terminate or retire. As long as they're owed a benefit, we have their records. And so when this request comes in, we scrutinize what's been given to us and make sure it's consistent with what we see on the database. Occasionally, not often, occasionally, there might be a difference between what's shown on the request as far as date of birth or date of hire versus what we see in the database. And if that's the case, a follow-up call or email will be made to the county's office to straighten that out. Similarly, in the next section, we're provided, this is section B, year-to-year employee contribution data. So in this example, this person was hired in 1996. So his contributions started in that plan year. And they go through the last month that he's employed, which would be September of 21. So September of 21 falls in the plan year starting July 1st, 2021, ending June 30th, 2022. That's the last line in the bottom of your sheet. It should say $2,474. So there, everyone see that?
Yes.
Okay. So again, this is what's provided to us, and we do the reconciliation. Is what we're getting now, does it match what we've been provided year by year in our database? And again, occasionally there's a discrepancy, and if there is, we go back to Karen or Sheila now. We'll go back to Sheila and discuss why there's a discrepancy. Maybe she gave us the wrong number, or maybe originally we were not provided an accurate number. But in either case, that's resolved. And then we go down to section C, just says, and this is typical, the participant would like all the available benefit forms provided. So not only the life annuity, but the joint and survivor annuities. We'll talk about that a little later. Still on the request, section D is the pay history. And this is very important. So your formula is based on the highest 36 months, which is almost always the last 36 months prior to termination. So Sheila provides us with a history for those final 36 months typically. And it shows a breakdown of all the different pay points. So in this example, the last raise that this participant received was July 1st, 2021, and he earned a base salary of $115,564 for the remainder of his employment through September 30th of 2021. Similarly, we go back in history, and whatever the pay points are, that's what needs to be provided. And Sheila needs to give us that data through at least 36 months. So in this case, this is going back to July 1st, 2017, which is actually over four years prior to termination. But in that time period, we need to capture, in order to get our full 36 months worth of pay, we need to capture 9 months of that pay period in order to factor into our averaging. So there's a 7/120 raise, and that was applicable for exactly 1 year, $113,468. The pay prior to that was a $112,590, and that was, my understanding is many of the officers got major promotions around that time period. You see a lot of them coming in March of 2020, a big jump in pay. In this case, this was March 6, 2020 to June 30th, 2020. Now, I'll note here, although that's not exactly 4 months, we use whole months when we average in the different pay periods to get our 36 months. So the very first one was for 3 months, and this next one was for 12, and the one starting March 6, 2020, that rounds out to 4 months. The one prior to that, starting in July 1st, 2019, going through March 5th, 2020, that rounds to 8 months. And then finally, because at that point we have 27 months, we need 9 more months of pay from the prior period. Again, that prior period was 2 years. That person was making $86,225, but we only pull 9 months from that. So Sheila and or Karen in the past, they've given us the pay, and they've given us that column that shows the months. But we spend lots of scrutiny looking at first the pay to see if it's consistent with what we see in our database, and secondly, just as important, as we're doing the final 36-month averaging, we put some good amount of time and scrutiny into, are those months that we're waiting per pay period, are they accurate? And assuming that's all true and good, we should have 36 months total with the different weightings by months. In this case, that the last salary is weighted by 3 months, the next one by 12 months, etc. And that creates a total pay for the 36 months of $305,467. When we divide that by 36, we get a monthly average of $8,485. And that will be pulled later into our calculation sheet that actually produces the benefit amounts. Does anyone have any questions so far? So we really haven't done the calculation yet, but this is sort of a walk through the process of when we get the requests, what are we looking at? What are we paying attention to? What are we scrutinizing? And in case there's any differences between what we have and what we expected to have, there's either emails or phone calls for discussion to reconcile that.
Mark, this is Catherine. Just to clarify, this is base salary and not overtime, is that right?
Correct. This is pensionable pay.
Okay, thank you.
So going down to Section E entitled Accredited Service, again, extremely important. This was provided to us in this example because I want to spend a little time showing some details on how military service is accounted for in the calculation. This person has 3 years of military service, pre-employment military service. Person has 25 years of service, excluding the military service. And then that adds up to 28 years of eligibility service. And on top of that, there is credit for unused sick leave. And that's half a year of service. Now that's determined by a simple calculation that's shown at the bottom in Section F. In this case, in this example, when the participant terminates, he or she is going to have 1,000 hours of unused sick leave. And that simply gets converted to a number of days by dividing by 8, that's 125 days. And then dividing by 22, that's 22 days on average per month. And that's 5.7 months, and that gets rounded to the nearest month. That's 6 months. 6 months is 0.50 years. That's where that's coming from. Sheila actually provides that for us, and that calculation is good and sound, and we just look at that and make sure it makes sense to us. So there's 28 years of eligibility service and 28.5 accredited service. So, by the way, and I apologize, the last few minutes I've been talking about page 2 of the request. So page 2 in your pile of slides. Hopefully you've been following that. Any questions?
No questions from the board, Mark. And yes, we're on page 2, section E for credited service. So we are following along as you're describing it. Thank you.
Hello, this
That's
is
great.
Jeanette. Hi. Are we supposed to be seeing the forms on the screen?
Yes, they're currently on
what
the
kind of
screen.
forms?
They're not in
Okay.
board docs, Jeanette. They're on the screen.
Okay, I'm not seeing them, and that's okay. I'll just keep listening.
Here, I can email them to her.
Catherine's going to email them to you, Jeanette.
I think I have them, but I'm not able to pull it up because I'm seeing Catherine's screen, and I can't get to my stuff. It
Oh,
might
I
be just
see.
my computer setting. So just continue. I'll listen.
Okay, thank you.
Oh,
Okay, now we're going to move to page 3. And by the way, I'm actually looking at my actual Excel sheet that you used to produce those PDF slides for you. And for me, this is the top of the page of the calculation. This top page looks very similar to what we saw in the requests. We're just bringing the actual raw data from the request over to our calculation sheet So you see some of the same information at the top, the name of the participant, date of birth, etc. And we're bringing over the service for 28 years and the unused sick leave of half a year. And then that totals 28 and a half years of benefit service. Now, again, we were given the service and the request, but we do some scrutiny here, and there's a small detail that I'll just mention here, and that's a credit is given for complete months worked, and then partial credit can be given for the hire month and the termination month. So in this example, the person was hired October 25th, 1996. So the first whole month would be November 1st, starts November 1st, 96. And the person terminates 9/30/2021. So that's 10/1/21 should be 24 and 11/12 years of service. Okay, that's based on the whole months. But now we got to look at the partial months. That's the hire month and the termination month. And your plan's a little different in this, in that in those combined months, if a participant basically works at least 1 hour, he or she will get at least one complete month worth of credit, or 1/12 of a year. And in fact, because you always work at least an hour in each of those months, you'll definitely get combined between those 2 months, the hire month and the termination month, at least 1 month of credit. The question is, will you get a second month of credit? And that's determined by your plan doc. That basically says if you have combined over 173 hours, and where does that come from? That's the number of hours in the year, working hours in the year 2080 divided by 12. That gives you 173 and change. So if you work, for example, combined in those 2 months, 176 hours, that's slightly more than a complete month, and the plan rounds up. And in that case, the person would get an extra month worth of credit. Okay? So we look at that, and we add to that the whether it's 1 or 2 months of credit, and that gives us our 28 years. And then finally, we add the unused sick leave that we looked at and calculated before, and we get 28 and a half years. So that's all good. Scrolling down a little bit, by the way, the 28 years includes the 3 years of military military pay, military service. So scrolling down a little bit on your paper, it's a repeat of the contributions provided, but here we're calculating interest every year and then adding that interest to the prior balance and the contributions to get the new balance for every year. So for example, if you look at 2020, which is the last, the 7/1/2020 is the last time the statement went out. We're working on the 7/1/21 statements now. So the balance as of 7/1/21 is not official for everyone yet. But 7/1/20, this person is showing $136,057. That's the accumulated balance of all the prior yearly contributions and yearly interest calculated. And that should match, within pennies at least, what we've shown in the prior benefit statement. And then since then, the person has worked a full year in 2021, plan year ending 2021, and then a partial year for 2022, 3 months worth. And Sheila provided that data to us too. It's $9,182 for 2021 and $2,474 for 2022. Interest needs to be added. On my sheet for the last year, it's highlighted in yellow, and that's showing interest of $1,506. Why is that so much smaller than the prior year? It's because it's been adjusted for just 3 months worth of interest. All right, and then you see a cell there that says total interest of $49,000. And the $49,000, I'm sorry, $49,000 is the total interest. That's in that middle column. What I'm not showing here is the total employee contributions without interest. That's $105,000, and plus the $49,000 in interest gives you the $154,000 in balance. I didn't need to go through that last exercise to get the $154,000 because that's accumulated year by year. But this is just an FYI showing you how much interest is built into that $154,000. Any questions so far?
Any questions from the board? No, I think we're still following along. Thank you.
Great. That's fantastic. Am I going too fast or too slow?
Just right.
Perfect.
Mr. Richards said just right.
Okay. That's great. So the next little section, I think this is the next page on your PDFs. It should show final average monthly earnings. Is that page 4?
Yes.
Okay. So I'm on page 4 for you all. Again, I'm just looking at my Excel calculation sheet. So the final average earnings was calculated in the request that we talked about previously, $8,485. Now the next 2 lines is important because your plan had an accrual improvement starting July 1st, 08. Prior to July 1st, 08, service earned prior to then earned 2% of pay for each year. And then for each year after 7/1/08, it improved to 2.5%. So we need to bifurcate the total of 28.5 years between those 2 buckets. The post 7/1/08 bucket and the pre 7/1/08 bucket. So we spend a little time scrutinizing. This is important. This is something that we do. It's not given to us. And there's some nuances to this because there's some details on how you handle military service, if there is any. And in this sample, there's 3 years. And also the nuance and the detail of handling the unused sick leave. So for post 7/1/08 service, which earns 2.5% per year, we go from 7/1/08 to when the person terminated, 9/30/21. And that works out to be at 13.25 years, 13 1/4 years. And your plan says all unused sick leave will be applied to post 7/1/08 service. And that's the half year. So we're going to take 13 1/4 and add 0.5. And then if there's military service, we're going to add all of it, a portion of it, or none of it, depending on when the person was hired and how much service he has. So when someone comes in with pre-employment military service, in this case 3 years, they don't automatically get credited the 3 years right away. The way your plan works is the participant has to work 4 years, get 4 years of eligibility service before 1 year of military service can be credited. So in this case, because the hire date was October of '96, this person won't have 4 years till October of 2000. And then again in October of 2004, they'll have 8 years. So he'll get credited with 2 years military service as of October of 2008. And then his third and final year of military service won't get credited of October of 2012. Which means, in this case, he's only going to have 1 year of post-7108 service credited for his military service. One of his 3 years is credited post-08, and the other 2, because of when he was hired, get credited for pre-7108. So going back to finish my thought here, the post-7108 service includes the 13.25 years of regular service, includes the half year of unused sick leave, and in this example includes just 1 of the 3 years of military service. That adds up to 14.75 years. And then, of course, the balance of his 28.5 years will be pre-7108 service. And that's why you see 13.75 years. Okay, doing the simple math, it's in our formulas. It's not explicitly on your page, but you see the accrued benefit of $5,462. That comes from taking the 14.75, which we just calculated above, multiplying by 2.5%, and then taking that product and adding the product of 13.75 years of pre-7108 service, multiplied by 2%. And I'm going to take a second here to do a simple calculation on my sheet that you won't see, to give you a benefit in terms of percentage of pay. Almost there. So I'll round for the nearest percent. So for the pre-08 service, that person earned 36.9% of his final average pay. And then in addition, his pre-08 service, he earned another 27.5% of final average pay. And those two together give him 64.4% of final average pay. So it's 64.4 times the 84.85. Let me say that again, the 64.4% times the 8,485 in final average pay is how we got the $5,462 in accrued benefit. That's kind of the crux of the talk, and I have a little more to talk about, but is everyone with me in that calculation, in that detail?
Is everyone
Yes.
following along
Yes.
with Mark?
Yes.
Yeah, and I think, Jeanette, you have the documents now loaded from email?
Yes, I do. Thank you.
Okay, great, thank you.
I do
Any
have a quick
questions?
question.
Sure.
Yeah.
Mhm.
Hey, Mark, this is Clay Safford. How you
Hi.
explain the bifurcation of the military service, were you able to is that incorporated in the online calculator? Because I understand in the beginning there were some issues doing that.
I recollect there was issues in the beginning, and that should have been resolved a while ago.
Okay.
Great. Any other questions?
And when you say issues, is that right when the portal went online, Clay?
Yes, and I know myself and Sean were doing some test runs on it, and that seemed to be a big problem to overcome at the time, if I recall correctly.
That should have been resolved, but can you do me a favor? If you or anyone tests it and you see something that doesn't look right to you, can you have Sheila email me? I'd be happy to investigate that directly. And again, I'm not aware of. I was told that this was resolved when the issue came up.
And Mark, Sean
In fact,
Moses
I was
here.
the person who laid out. I was the person who laid out to our staff, based on the interpretation of the document, how the military service should be credited, and they were to use that to actually code the portal.
Hey, Mark, this is Sean Moses. How are you?
Hi, Sean.
Quick question about accrued sick leave. To Clay's point that there were some issues with the military service. There still appears to be a max benefit of 4,000 hours on the calculator, and there are a couple of people who have exceeded that. So while we're talking about the calculator.
Okay, so honestly, offhand, I don't remember if your plan has a max. I think you're telling me that it does not have a max.
I don't believe it does.
Okay. I will look into that. And is it okay if I get back to Sheila and she can communicate that to you and whomever?
Absolutely. Thank you.
Okay. Do you know how many people that impacted?
I can give, offline, I can give a specific person to test that on.
Okay. Okay, that's great. But it sounds like, is it just one person or a handful that you saw a problem?
I think it's I think it's about 2 or 3 that have that issue.
Okay, and just so I make sure I understand specifically, it's these handful of people had more than 4,000 hours of unused sick leave, and it looked like the portal was capping it at 4,000.
That's my understanding, and that was addressed early on, and I don't remember if it was ever resolved, but within the last month or so, one of the employees brought it to my attention again.
Okay. Okay, I do remember the military service issue, and that should have been resolved. I was never aware of a sick leave issue, but I will look into that. Any more questions before I continue?
Yes, if I may, Mark.
I'm almost finished, by the way.
This is John Walters. What is the background
Hi, John.
for the constant 4% interest crediting? Where's that coming from?
That was, and I don't want to get this confused with the drop. I'm hesitating because let me go back a second. Let me see if I see something in I think it's always been 4%.
I think it's
And-
in the document.
What? Did someone say it was higher and we changed it recently? I think in general, John, way plans work is you keep your money in the plan and they're going to provide you interest, but they're not going to provide you interest at the valuation rate, because you could not, and the valuation rate is like 7.25%, because in a no risk way, you can't go out on your own and earn anywhere close to that. So the plan is providing participants interest accumulation without any market risk at above market rates. I mean, now it's like 1%. That's in general. I don't know specifically how 4% was arrived at your plan.
Mark, this is
But
Catherine. It's in the plan.
That's not atypical.
Mark, this is Catherine. It's in the plan document.
Okay.
4%.
Thank you. I'll look for
Yeah, it should be in the document, but I thought the question was how did the plan document arrive at 4%? That I don't know.
But that's why it's there.
Okay.
Yeah. Yeah, well, whatever we do should be consistent with the plan document. And yes, that's in the plan document. I thought you were asking why was it determined that 4% should be the rate we use in the plan document?
Well, I sort of was, but I'll dive into the plan document and see if that answers my question.
It might be in that summary you provided to me recently, Catherine.
Yes.
I'm
Any other
looking at the
questions
summary
for
now, see if
Mark?
I can quickly.
Okay, Mark, I think we can continue to move on.
Okay. So we've calculated our accrued benefit of $5,462. And now we need to provide the benefit optional forms. And these are forms to protect the beneficiary in case the participant predeceases the beneficiary. So these are joint and survivor annuity options, and they're calculated actuarially based on expected lifetimes of each participant based on our mortality tables. And that concept is also integrated in with the actuarial equivalent interest rate. Okay, that's sort of fancy naturalese to say that if we were to give you, the participant, a choice of providing a benefit of $5,462 for life, but the participant wants to protect his spouse or beneficiary in case he predeceases her or him, then that original benefit needs to be reduced to reflect that there is the possibility that the participant might die, and in the first option, the life annuity option, the benefit would cease, and the plan would have no longer have a liability for that participant. The continuation to the spouse or beneficiary. So the benefit needs to be reduced. You're seeing reduction factors coming from our actuarial software that I'm showing. I'm not going to get into exactly how that's calculated because it's pretty complicated. But the point is you see reduction factors that are less than 1. So for example, that first benefit of $5,121, in that option, we're recognizing that we're going to provide for the participant as long as he lives. And I'll just say the participant's Joe Sample. So as long as he lives, his family, whatever, his household will get the $5,121. If his wife dies before him, there's no change. Still gets the $5,121. If he dies, then his wife is protected for half that amount, and that's the $2,560. $2,560 is half of the $5,121. How did we get the $5,121? We simply took the actuarial reduction factor that's based on the interest rate and the life expectancies. In this case, it's 0.9375. And we multiply that by the 5,462. And then you get the 5,121. Anybody have questions with that?
It's John again. Which mortality tables are you using by date? Do you know?
before I speak, we've changed some. Let me make sure we're,
We updated them. That's also in the plan.
take me a second to look up. Yeah. I think in the last year or two, we changed our actual equivalents. I'm pretty sure it's now RP 2014. Let me. Yeah, it's an up-to-date table. It's called the RP 2014 table.
Thank you.
Any other
And the
questions?
interest rate is 4%. That's the actual equivalent interest rate. So similarly, for the other optional forms, we take the same accrued benefit, $5,462, and then we multiply it by the applicable optional form factor. So the joint and 100% is 0.882 and change. The pop-up joint and 50% is 0.927 and change. And the factor for the pop-up joint and 100% is 0.863 and change. In case some in the audience don't know what the pop-up is, it's similar to the joint and survivor. The difference, though, is if the spouse predeceases the participant, the benefit that the participant is receiving prior to that death will pop up to the original accrued benefit. So, for example, in this case, the joint and 50% pop-up is I'm showing is $5,064. Again, that's simply the 0.927 factor times the accrued benefit of $5,462. If the participant dies first, then there's no difference between how that works with the joint and 50. The spouse will get half that, $2,532. But a little different from the joint and 50, if the spouse predeceases, at that point in time, the household will no longer get the $5,064. It'll pop up to $5,462. Because of that pop-up, that's why the adjustment factor is bigger for the pop-ups. And that's why the 50% pop-up is slightly less than the regular 50% survivor annuity. 5,064 is slightly less than 5,121. That difference of roughly $60 in monthly benefit is the price to pay for that sort of insurance of having to pop up the benefit later. Any questions with that?
No, the board's showing no questions, Mark.
Okay, and finally, what I have to share, unless there's other questions, is the election form. That should be page 5. And I have to open it up on my end.
I'm sorry, I do have one question before we go to page 5.
Sure.
Okay.
Ahead of the annuities, it says approximate number of months until cash refund period ends. And it's 28 months.
All right, okay. That's a good question. I'm sorry, I skipped that. So I mentioned kind of a simplicity. I described that the accrued benefit as $5,462 as a lifetime benefit. To be more detailed and more accurate, it's a lifetime benefit, but subject to a guarantee. So, and what I mean by that, if the participant were to die prematurely, let's say within a year of, it doesn't have to be within a year, but let's say within, I'm just making this up, 10 months after he started receiving the benefit. First of all, he didn't elect the joint and survivor options. He elected the what's called a modified cash refund, the accrued benefit of $5,462. His estate would receive the difference of what he got paid as long as he's alive, the difference between that and his employee contributions with interest. And the theory is, the idea is, well, the participant himself put in his own money, and he earned interest on that money. And in this case, it's $154,000. If he elects that lifetime option, his estate should be guaranteed at least of receiving the $154,000. So that is used to, let me open my election form, because that helps me see it better. And I'll finish my thought and my explanation.
It's option 1 on page 2.
What's the election form? That'll tie in with the questions. So this is, and I don't remember, is the election form all on one PDF page?
It's page, I think you're looking for page 2, Mark, option 1, right at the top of the second page.
Yes, okay, so that's right. So the person can elect option 1, which is the accrued benefit, $5,462. But you see the description there, what happens if you die prior to receiving in payments the value of employee contributions with interest. That's the $154,000. The remaining balance will be paid to your beneficiary. So a simple example is, let's suppose this person retires, and after 10 months, after 10 payments, he dies. So he received 10 payments at $54.62, and that's roughly $54,000. The difference between the $54,000 and the $154,000 is $100,000. That $100,000 would be paid to the beneficiary. Okay? So going back to the question, what's the 28 months? Well, the 28 months is to reflect the fact or idea that when selecting a different optional form, one of the joint survivors, 50 or 100, doesn't matter, the regular or the pop-up, it doesn't matter, you're not starting with strictly a life annuity. You're starting with something that's a little more valuable than a life annuity because of the guarantee period. And so that helps to increase. If we started with a life annuity, your joint and survivor conversions would be smaller than when you reflect as your starting point a life annuity with a level income guarantee. In this case, it's 28 months. We round that to nearest years. So this person is really getting a life annuity with a 2-year certain component to it. So that aspect, the fact that there's a guarantee period of 28 months, which rounds to 2 whole years, affects the conversion factors that were used to produce the survivor annuities. They're slightly higher than they would have been if there was no guarantee after the participant's premature death.
So is it fair to say that that 28 months represents the first 28 months would be they're getting paid their contributions plus interest? Is that another way to say it? They're getting paid their contributions and interest.
Because we're right, because the $154,000 is what we're guaranteeing, and that includes contributions and interest.
Understood.
Mark, this is John again. So if some of that 154 does come back to the beneficiary, how is that treated to them? Is that a life insurance payout, or is it an income for tax purposes?
Now that is treated I'm not a tax accountant, but I believe that that's treated just like the monthly annuities as income.
It's not treated as
It's like a
return of
large
principal.
single. It's a pension payment, but it's like a lump. Some plans have lump sum options. More generally true in the private sector and the public sector. But my understanding, those lump sums, those one-time lump sums are taxed the same as the monthly annuities would be taxed.
Okay, thank you.
Any other
Okay, so
questions?
I finished talking about.
Sorry to interrupt, Mark. No other questions.
Okay, so the final thought is just spend a couple minutes with talking about the election form that we just started looking at. Sorry, I have to open mine up again. So simply, this is like the final product that we produce, send to your office, Sheila's office, and she provides this to the participant who's retiring. And much of this is just a repeat of what was in the request, what was in our calculation, you know, the raw data up top, the type of the retirement, the demographic data up top, including any beneficiary information. And then the crux is the second page, the bottom, with the different benefit amounts that you saw on page 4, are now here on, for you, page 5 of our slides. Each of the benefit amounts are coming directly from a calculation sheet, and with a description of what each form is or means. So it's simple as that. That's all I want to say. If someone has some questions on what the meaning of these forms are, I kind of attempted to go through that earlier, but any questions on this or really anything else?
Thank you, Mark. Very informative and very detailed. Very much appreciate the presentation. Are there questions or comments from the board members?
No, just as a statement, a couple of retirement estimates that I got to look at were purely in the form of an Excel workbook. And that's where a lot of the confusion was. I didn't see any document that was concise like this in a PDF. So we had to do a lot of guessing. I guess when they came in to actually do the paperwork, they would see.
Yeah, you shouldn't have to do that. Yeah.
Yeah, so what we were looking at was.
Now, I know.
I'll jump
Go
in,
ahead, I'm
Mark.
sorry.
I do. I think Karen provided an estimate using this sort of a back of the envelope estimate for people before getting the official estimate.
Okay, so would they be allowed to take the official estimate out of HR and mull it over and look at it and kind of digest it moving forward?
So I think that's a question for you all, because there's a cost when we ask Bolton to do the estimates. And so in the past, we've waited until somebody is at that place, because as you well know, people very often want estimates multiple times throughout the years. So we have been reluctant to get a formal estimate every time someone wants one.
Well, and I guess wouldn't that be duplicative now that we have the online estimator? I mean, we
what is the
purchased
difference?
that.
Yeah, Mark, what's the difference with the online estimator and this product you've shown today?
Well, the online estimator is using data that's provided to us every year in order to do the valuation, the statements. And sometimes the data, the salary data, might be a good estimate of what was earned in the last 12 months without calculating, you know, the weighting of those different pay points within the year. So that's one reason why when we produce a final calculation, it could be a little different than what you're seeing in the portal. And the idea, though, is when we do the calculation, real dollars and real cents down to the penny are being paid. Oh, it needs to be exactly right, meaning there's no assumptions. It's every piece of data should be correct to the penny. Also, my understanding of the portal, and again, I didn't design the portal. It's not really my expertise. You, the participant, can put in different scenarios, like different. If we're in 2021 now, what if I retire in 2023, and put in an assumption for what's your pay increase between now and then, and you can. My understanding is you can use the pay history that's already been loaded into the portal, or you can override that with your own final average earnings. So, I guess one of my points is you can produce lots of different things out of the portal, but when it comes time to do the real deal, there's no projection. It's going to be based on actual numbers, and the closer that projection or that calculation is done to when you're actually retiring is important. I know, because you need time to look at it. Generally we get a request 1 month, sometimes 2 months ahead of time. So your office is estimating, and they probably already know this, that in the next 1 or 2 months, your pay is going to be the same as it was in the prior month. There's no reduction, no promotion or whatever. And so in that sense, we're projecting a month or two. But we really need the actual data up to the last minute, and not rely on something that's, might be slightly more of an approximation just based on the data that's coming in.
So the workbook that I looked at for the particular participant was produced by Bolt and forwarded to the participant, and it was 3 or 4 sheets in that workbook. My point is that we had already paid Bolton to produce the estimate. It was not a concise document like we're seeing here, so we had already paid them for it. So I was just wondering, at what point in our process did they see the document? That's how I was able to look at it and recognize that there wasn't any adjustments for the pay raises that occurred post March of 2020 by looking at that sheet. So,
Could you send us a copy?
Yeah, well, I don't know what happens exactly on your end, but on our end, when we get a request, we do all the analysis I just explained, and we're scrutinizing the data and actually doing the calculation in our Excel sheet, and retrieving the appropriate actuarial factors for the optional forms. But we always accompany that calculation with a summary, what we call the election form. So maybe in the past, and that might have been an arrangement between Karen and the officer, can you give me a quick estimate? And maybe Karen did that on her own, or maybe she used maybe a statement estimate that we had before and adjusted that in her own Excel sheet. Maybe the statement was from 2 years ago, and she adds whatever, 1.5 years of service and bumps up the pay a little bit. That's a possibility. But whatever we would send as an official benefit calculation should also be accompanied with this election form that shows the different choices the participant has to make.
And I would think, it was my assumption with the estimator that HR would not do those informal kind of estimates anymore because it wouldn't be necessary, and that the employee could actually go into the estimator and do it themselves with those different scenarios. And so hopefully what you're describing is a thing of the past in terms of, what we're hoping in the future for folks to have more consistent information.
I'll talk to Catherine and Sheila about it, but it was the actual workbook produced by Bolton. It wasn't something, it was far more depth and detail than the normal estimator that Karen was previously providing. And that's what was getting shuffled back and forth between Bolton and Karen's office to figure out that the pay raises after March weren't in there.
Right, but what I'm saying is I still think that back and forth would no longer apply since we have the estimator.
Yeah, he wasn't trying to get any kind of estimate. He was on his way out. It was a disability application.
Okay.
So it was it was recent. But I was looped in on the emails eventually, and I'll be able to show it. But as long as he didn't have a very clear, and there was calculations in there that none of us, Karen wouldn't have been able to come up with, that only the actuary would be able to do.
Yeah, if you'd send us a copy, that'd be great.
Yeah, yeah. And then I just have a couple questions about disability in general, if we're ready to move on.
If I could just jump in for a second, and Dr. Bridget, you're right. Sheila and I are not going to provide estimates. We'll rely on the benefit estimator. And then when someone is more seriously, going to retire, considering retirement, we'll send it to Bolton.
Good, thanks. That's what I thought was happening. I appreciate the confirmation.
Sure.
Are we ready to go to the disability questions? Okay, Lieutenant Moses.
All right, so in the plan document, if you, specifically, I'm looking at page 25, and we're talking about whether or not it's a line of duty, catastrophic disability or non-catastrophic, Mark. The plan calls for the participant to get their contributions in either, if it's a line of duty that's catastrophic, then they get 66 2/3. If it's non-catastrophic, they get 50%, but in either case, they get their
50%.
their contributions.
That's correct.
So
Yeah, they get the actual, they get an annuity. They get an annuity that is the actual equivalent of those contributions. They get that portion. You can think of it as two pieces. They get 66 2/3 of pay if it's a catastrophic of their final average pay, and then on top of that, added to that is their employee contributions with interest converted to an annuity that's actuarial equivalent.
can you explain how that contribution? So in this particular case, if it was $154,000 in contributions plus interest, or it'd actually be less because we wouldn't give them their interest. But, if it's $100,000 in contribution, how is that converted to an annuity?
Okay, to help me answer that, let me just quickly open up a recent one we did. And by the way, these line of duty disabilities don't come up a whole lot often. We had like one or two in the last couple months, and then prior to that was 7 years. What's more common are the ordinary disabilities, the non-line of duty. But I think we've gotten two, after a 7-year absence in the last couple months, 2 or 3 months, we've got two line of duty disabilities. So I'm going to open up, at least on my end. So what I've provided you today is the more common case, a regular service retirement. And what I'm about to talk about, you can't see, you just have to listen. This is the long-term, not the long-term, the line of duty disability. So there are similarities. We still have to calculate the accrued benefit as I described for a regular retirement, because it is possible, generally not likely, it is possible that the regular accrued benefit can exceed the line of duty disability benefit. So you actually need to compare the two of them and take the greater. But aside from that, so I'm looking at a non-catastrophic I'll sort of make these numbers up based on an actual. So let's say the final average pay was $8,000 a month. 50% of that is $4,000 a month. What gets added to that is the actual equivalent of his employee contributions with interest. In this case, the contributions interest was $100,000. And that would be, the plan document says, take the actual equivalent factor, the life annuity, that age. Let's just say the person's 50 years old. I'm making that up. And for a 50-year-old, the actual factor will be about 20. So just using round numbers for simplicity, the 100,000 divided by 20 is $5,000 per year. So said this way, that $100,000 in employee contributions with interest on an actual equivalent basis can purchase an annuity of $5,000 a year divided by 12 is a little more than $400 a month. So call it $400 a month. So you take 50% of the $8,000, that was the $4,000, and then you add to it the $400 afforded by the employee contributions of interest. So my example, the $4,000, call that the base amount, the 50% amount plus the $400. That's the actual equivalent of the contributions. That adds up to $4,400. And then you're done, and then you calculate the annuity forms like you would a regular retirement benefit.
So it's possible that the participant who does a disability, I understand it doesn't happen often, but these are questions that we're starting to hear, that annuity for their contributions could exceed what they actually put in if they lived long enough.
Absolutely. It's theoretically, on average, it should be the same. Some people will die a little earlier, and they won't get it all back, and that's true of anything. But having said that, the caveat to that is if you elect the just like the regular retirement, the life annuity, which is really a modified cash refund annuity. So if you take that rather than a joint survivor option, then you will be guaranteed to getting that account balance back in some way. You'll get back at least that.
Right.
Got it. Thank you.
Does that answer your question?
It does, because we were looking at it on a very raw Excel workbook and trying to extrapolate what it actually meant. And doing the math, it didn't make, in the actuarial world, it makes sense, but in like real world, it didn't add up.
Yeah. It sounds like what you're looking at was sort of a piecemeal thing, and it didn't have really any, I don't know what the word is, completeness or continuity to it. It wasn't all wrapped in one package.
Mark, this is John again.
But it really,
Go ahead.
let me finish. It really is, it's not that complicated, at least in a big picture. The service retirement, we talked about how that's calculated. And then when you have to do a disability retirement, you still calculate the service amount in the event that it's greater than the disability formula. And the disability formula, in the more common case, is the ordinary disability, which is you project your service to earlier of 62 or when you would have had 25 years. So, if you had projected 25 years, that's 40% of final average pay. That would be an ordinary disability benefit. If you would have hit 25 after age 62, then you project to less than 25 years. So with an ordinary disability, you're going to get at most 40% of your final average pay, except there's that you need to compare it with your regular benefit. It's possible you've already worked, 20 years, and 20 years would be over 40% of final average pay. So in that case, in that example, the person going out on disability is not really any benefit to him. He'd be better off just taking the service retirement. The caveat to that, though, is it depends how old he is. The disability benefit, regardless of age, is not reduced for retirement prior to age 62, unlike the service retirement. So that is a big factor. And then the other disabilities that we talked about are the line of duty. It's either 50% or 2/3, or 66 and 2/3% of pay. That's a simple calculation times the final average earnings. And then add to it something a little more complicated is the actual equivalent of those employee contributions. Generally round numbers, it depends on the age, but generally you would take the contributions and divide it by 20, and would be the annual amount per year. If the person is younger than that, it might be a little more than 20. If he's older than that, the annuity factor would be a little less than 20. But 20 would be a good just ballpark stab if you're doing a back of the envelope.
Great, thank you very much. Anything else? Any other questions or comments? Thank you, Mark, very much.
Just
Anything
one
else?
quick thing. Mark, when do you expect the annual statements to hit the streets on the portal?
I think we're working on them now. My expectation would be the first week of October.
Okay.
So what is that, 2 weeks away?
And will that be an annual time frame, or does it vary year to year? I've had some questions recently.
To be frank with you, it should be. Yeah, it should be. We're aware that, historically, it should be done around, beginning of this time and sometime before October 15th. And so we're in that window, and we try to be in that window. So I would say in general, we should have them done every year between September 15th and October 15th.
Okay.
And it does depend on when we get the data, but typically we get the data well ahead to make that time window.
Mark, this is Catherine. I'll follow up with you and make sure to send an email to everybody as well, once we know the date.
Okay.
Thank you.
Okay.
Great, thank you. Anything else for Mark Bolton? Good. Hearing none, Mark, thank you very much for the retirement calculations and the review, and we look forward to it. Thank you very much.
Okay, you're welcome. Thanks for inviting me.
So next on our agenda for the board is 3B, which is the asset value update, investment policy statement review, and next steps. And I'll turn it over to Pat Wing for your review. Good afternoon, and thank you for your patience today.
Good afternoon, Dr. Bridget, and good afternoon to everyone else. And we have a few things on the agenda today, but it is a rather light agenda. So we'll take a look at the asset value update first. We'll spend the bulk of our time talking around the investment policy statement, some of the feedback from the trustees that we got, and then we'll just wrap up with some next steps. So everybody should have, hopefully, the hard cover book in front of you. If you would hop behind Exhibit 1, if you will, on page 4 it should be. Yes, on page 4, just a quick update on where things stand. Now, this data is as of about a week ago, but if you look up top in that table to the third row to the right where you see total assets. So total assets of the pension fund were $134.7 million as of about a week ago. It's actually up about $3 million since we last met, even though equity markets have been relatively subdued, to say the least, from a total return perspective. There's been a little bit of volatility along the way over the past couple of weeks, but they've generally been pretty subdued since then, and interest rates haven't done much. What really drove that increase was we started getting in the Q2 values for the private markets investments. And if you recall, public markets did quite well, equities during the quarter, REITs during the quarter. So in sympathy with that, we've seen a lot of those Q2 statements come in with upwardly revised values. So that really drove the increase that we've seen over the past 4 weeks. And you'll notice a couple columns over to the right under rebalancing, there's nothing there. So we don't have any recommendations for the board to consider today. And what's really driving that, for just a little bit more context, if you look at the bottom of the page in that little box to the left, where we sum up the asset allocation for each respective asset classes, and you look at that column to the right there where you see difference, again, anything in green is reflective of an overweight relative to the target and vice versa for red. And if you recall, when we talked at many meetings before, in the current policy statement, we have basically a range of plus or minus 9 percentage points for equities. So when you sum up U.S., developed, non-U.S., and emerging, we're right around 8% or so. So we're well within those guidelines. And more to that point, this is essentially where we're headed, right? We're decreasing the allocations to alternatives in the new policy statement, increasing allocations to traditional assets like equities and fixed income. So right now we have a decent overweight to equity markets, but that's being sourced predominantly from alternatives. You know, what's being trimmed heading forward, specifically commodities and specifically the hedge fund allocation. So we're comfortable where things stand today, given that, and given that's the direction that we're headed. So with all that said, I'll pause here for a second. Any comments or questions as it relates to the asset value update before we move on?
Just one.
Yes, sir.
The top number, the 134.7, that's of 9/23 or the end of the previous month?
Actually, as of 9/16, so there's a lot of data on this page, Mr. Walters, but if you look on the left, underneath the large table, there's a footnote there underneath total cash and equivalents market values as of September 16th. Yeah, so about a week ago. So we update the data on Friday morning, last Friday morning, to get the materials out to the board so they can be posted to board docs. So there's about a week lag in the data itself, but it's fairly recent. Okay, any other questions?
No?
Good? Okay, great.
Yeah.
So we could move on to B3 then, which would be the next section in your book there, so behind Exhibit 2. And before we dive in, so we continued, this is essentially the culmination of all our meetings and discussions this year, right, that we began earlier on, whether it be asset class education, asset allocation studies, developing the long-term strategic targets, and then finally bringing that all together into a policy statement. So what we'd like to do here is, I also have a draft of the statement to use for context so we can work along with the board provided feedback, but basically discuss those suggestions, so we'll kind of walk through them one by one. I might provide a quick comment at the top, but then pretty much open it for discussion about whether or not to incorporate them into the statement. And we should be able to walk through it fairly quickly. But before getting there, if we take a look at page 6 here, just quickly, again, for context. So at the July meeting, and I recognize that the composition of the trustees that were at July were a little different for those of you here today, so I wanted to run through this quickly. But at that July meeting, we performed an asset allocation study where we showed the 4 sort of options that you see in that table below there. So there were 4. That first option where you see 65-35, we showed mostly as a reference point, not all equities, but 65% equities and 35% fixed income, to see what the base case scenario would look like relative to the other 3 options you see to the right there. Now, the middle 2 were options recognizing the fact that we can't get out of many of the alternatives tomorrow, right? The private equity, credit, real estate, those are something that are going to be around for a number of years. But the point of those was to say, okay, well, we can't get to 65-35, but what can we do, given what we have and given the timing of when it's going to roll off? What can we do? How can we change those allocations? And those two specific ones were essentially, think of more interim targets, saying, these are the allocations, but as these funds roll over time, we'll try to make it more of like a 65-35 approach. The latter to the right that's boxed up is that the actual allocation that the board approved at that time, and you can see the headline at the top there, MAI, that's Marquette Associates Incorporated, was our recommendation. So that was the approved asset allocation of the board, which at the time we talked about will be reviewed every year, minimum every 2 years to make sure we're on the good long-term strategic path. But these targets essentially imply, at least at this point, that we're going to try and maintain those allocations to private equity, to private real estate, to private debt, based upon the discussions, the information, the analysis that was provided to the board at that time. So that's something that we monitor. We've talked about this at previous meetings, the allocations, what would need to happen to maintain them moving forward. But I did want to provide that context because as we work through some of this feedback, I think it will be helpful with some of the suggestions just to keep that in the back of our mind as we work through some of this. So with all that said, if you look in the right behind Exhibit 3, or excuse me, right before Exhibit 3, you'll find a draft of the statement itself. And again, what I'd like to do here, and I think, a lot of this can be covered in short order, but the goal really is to work through these, to, come to a little bit of a consensus with these various items, and then at our next meeting, provide you a red line draft of the IPS incorporating anything as appropriate, so we have it in one document and can take a look at how the initial draft has been adjusted based on trustee feedback that we've received. So we'll start on page 7 here, and you'll note at the top where it says board suggestions -text. So these are suggestions related to the language in the document itself, the IPS document, which starts on page 3. So the first item for consideration there, and this would be on page 7, and we'll kind of go back and forth, and I'll try to be as clear as possible about where we are in each document. But the first suggestion is simply to provide a section or a brief paragraph on governance. You can see, again, number 1 on page 7, explaining the makeup of the board trustees by position and things of that nature. Basically, what role everybody plays in the portfolio, in terms of policy. That language we don't typically see in the policy document because it's defined in the plan document. We could add it if the board would like that, but it is defined explicitly in the plan document itself around who the trustees are, the position, how they're appointed, and things of that nature. So let me pause there for a second to get the board's feedback on whether you think it's appropriate to add it to an additional document.
Any comments from the board? I mean, I think it's fine.
I don't.
I don't have any objection to it.
I stand by my recommendation.
Okay. Jeanette?
No, I'm fine. I agree. Thank you.
So we'll
Okay.
add. So
Yeah.
we
Thank you.
We can certainly add that.
Yeah.
And if you'll bear with me, I'll just make some notes as I go along here. So on page 2, and this one will be quite quick, on page 7 in our document, it says number 2 on page 3, at the risk of having you read that, it's basically insinuating that there is a missing word. So if you look at page 3 of the draft of the IPS, in the second to last paragraph that begins with, in developing this IPS, the end of that paragraph, you can see says modification of this, and then there's a blank. There's nothing there. So that is a mistake on our part. It should say of this IPS.
Of this
period.
IPS?
Yes, sir.
Great.
So we will add
Okay.
that as well.
Thank you.
On page 7, again, in the hard copy book, we're now on number 3, and this is related to page 4 of the IPS. So on page 7 of our book, number 3, there's some clarification being desired here, basically around the fact where we state in the document on page 4, and this is bullet point 6, so this would be under responsibilities of the investment consultant. The third bullet there, it's the 6th bullet on the page, but it's the third bullet under there where it says, recommend investment managers, it has some things in parentheticals, with discretion to purchase, sell, or hold specific securities, et cetera, et cetera. The suggestion here is just to essentially clarify that that discretion is within each own manager's respective accounts and strategies. So just a simple qualifier, I think, is perfectly reasonable, and we can make that change.
Is that okay with the board?
Yes.
Okay, great.
All right. Moving along. So now we're on the same page. This is number 4 on page 7, and it is the bullet point below the one we just covered. So below the recommended investment managers, this is where it says, after the initial selection of an investment manager, and this is our responsibility, Marquette, or any investment consultant that you work with, regularly measure, monitor, et cetera, et cetera, et cetera. The suggestion is, as it's written, and I can see how this is it implies in essence that we're not going to monitor a legacy manager, right? Somebody who's already in there. Obviously, we do that. So the simple suggestion is to just, simply state in number 4, investment managers will be regularly reviewed, monitored, et cetera, et cetera. So essentially, we would strike that first clause after the initial selection. Again, think it's perfectly reasonable, good change, and if the board agrees, we'll go ahead and make that.
Is that okay with the board?
Yes.
Okay.
Yeah.
Great. Okay.
All right, moving along here on number 5 on page 7. This is very similar to the number 3 that we saw, but if you move to page 5 in the document, in bullet point number 1, so the top bullet point again, as it relates to investment managers, it says exercise full investment discretion. And again, this is the same sort of idea, just to clarify that it's within their respective strategies that they're running for the pension as opposed to being broader. So it would be the same change that we just all agreed to on number 3 to make it clearer on this bullet point as well.
Is that okay?
Yes.
Okay.
All right, great. So next this is number 6 on page 7. And then again, it's on page 5, but bullet point 3. So this would be 2 bullet points below the one we just mentioned, the one that starts with provide reports and data sheets. So this is again under responsibilities of the investment manager. And if we look again on page 7 of the hard copy book, the suggestion is that, yes, they are giving us reports, but want to have some sort of deadline, if you will, no later than X business days. So this one's a little trickier because since we're using mutual funds and collective vehicles, we can't necessarily enforce when that data is provided. We collect the data, but some mutual fund companies might not release it until 20 business days after a quarter end, might not be 30 or even 45. So since we don't have the authority of how to enforce when we get the data, I think it'd be difficult to put in a specific date unless that date is very well after quarter end.
And similarly with the private holdings, because they're very delayed.
Correct.
Yeah.
Yeah, I thought you were going to hang your hat on the private investments.
Well, I think you can hang it either. We can hang it on either.
Yeah, but on a mutual fund, at the end of any given day, you got the investment, and the end of the month, whatever.
No. Many mutual funds will not release their holdings during the quarter, and they do not release them until a certain percentage after quarter end. So say, I'll pick a name here, say Vanguard, for instance, for any of their actively managed funds, they will not release the previous month's holding to at least 30 days after business end. And that's become more and more commonplace where the managers will not release that information due to compliance concerns, regulatory concerns, and things of that nature until well after month end.
Concur with that, but I think I was reading something into that that doesn't actually exist. I was thinking of valuations as opposed to an SAI statement of everything we own in Fund X. I don't care about that. That's going to change anyway. But valuations, I would like to see have, with the exception of the private stuff, which are forever, some sort of a deadline for valuations being reported.
Well, outside of the private, and we could put a specific day in, but that would essentially be the same business day, right? So if we think about mutual funds or other commingled funds that are priced daily, those daily valuations come out at about 6:30 Eastern the same day. So, I mean, we could put in within one day if we want, or, we
But
could
then we're
certainly-
still hung up on stuff we'll never see for another 2 or 3 or 4 weeks. The private side.
Oh, much longer than that, sir.
Yeah.
Yeah, yes. So, I mean, we can qualify it as it relates to public versus private, if that would be more,
How about as soon as
Animal.
practicable?
I think that's a good middle ground.
Are the board okay with that compromise?
Sure.
Yes.
Good, okay.
Okay. So our next suggestion, this would be number 7 in the hard book, under page 7, under responsibilities of the custodian. And one of the questions was around pricing daily and reporting, and whom would that be reported to? And then again, another sort of no later than deadline, something that we previously discussed in the previous bullet. So this specifically is under page 5 of the IPS, in the first main section where you see responsibilities of the custodian. So firstly, when we think about pricing daily and reported to whom, the back half of that paragraph, in the middle of the third line, when it starts talking about record keeping and reporting, basically what we're talking about, at the end of that sentence, which is the second to last line, it says reasonably required by the trustees and staff. So that's where the information is going, to whom it's reported, trustees and staff. And then you see that final line, nationally accepted pricing should be daily and reported. It's implied, again, that it's trustees and staff, but we can certainly repeat that if the board would like at the end of that sentence, not less often than monthly to the trustees or staff as appropriate.
I'll withdraw that suggestion.
Understood.
Is that okay? The
Okay.
suggestion's no longer warranted, so we'll cross that one off. Thank you for the clarification.
Yes, and then there's the other half of that, no later than, that's the same issue we're running into. So we can say as soon as practical, if that works as well. Okay. All right, so moving on here, number 8, on page 7, it says under standard of care and prudence, suggestion to change the word obligations to objectives. So this is on page 5 of the IPS. In the middle of the page, you see a header of standard of care, then under prudence. So if I can draw your attention to that first sentence that talks about guidelines respecting prudence have been developed, et cetera, related to the plan's obligations, which is another word for the benefit promise to the participants and beneficiary. And I believe the obligations that are in quotes that are under review here is in the next sentence, where it says actuarial, economic, investment, and socio-political events, amongst others, are factors that affect meeting those obligations. So in this section, we are still referring to the obligations or the benefit promises, not the investment objectives. But if somebody's reading that differently, we can consider wording it differently.
No, I understand what you're saying now.
Okay.
Okay with that.
Okay, great.
Yeah, I'm okay with leaving it obligations.
Good.
Other folks okay?
Yeah.
Yeah.
Okay. So now we are on page 9, excuse me, page 7 of the hard copy, number 9, and page 6 of the IPS. So this is a similar idea that we talked about firstly around governance, where the question is, under delegation of authorities granted by whom? What it's defined in the plan document. So if the board would like it to be more explicit in this policy, then we can just borrow the language of the plan document, if that would be amenable.
Yeah, that makes sense.
May I make a suggestion? The governance language and the detail from the plan document, potentially that is an appendix to this, because it can be quite lengthy. So in other words, an appendix to this investment policy statement could be the language from the plan document that describes the governance, that describes the delegation of authority, et cetera, et cetera.
I think for this, it's just simplicity, right? Is that you really just want to say is granted to the trustees by, and then it's the name of the document. I don't think it has to be as complex as the
By the plan
appendix.
document, in other words, and not repeat the language from the plan
Right.
document?
Right.
Is that what I thought we
Right.
were talking about the former, actually, but
Yeah, so did
let me
I.
be clear. Or-
I guess I had in my mind by the St. Mary's County Commissioners.
Well, but it's the commissioners, it's
The plan
it's the
document.
plan document that lays all that out.
All right, and by the plan
Right.
document.
Right, so I think it's just the
Cite the
title of the,
plan.
you just cite it instead of the whole
Understood.
document.
And is that what you thought for the first item that talked about governance?
Yes,
So we're just referencing the plan document, we're not copying 3 pages from the plan document and inserting?
No, that was never my intention.
Okay.
Right.
I'm sorry.
I think it's simplicity so that if someone's
Yes.
looking, they're the next document, instead of doing it as an appendix or something, it references where the authority comes from.
Perfect.
Yeah, I think that's a nice
Yeah,
way to
that's
split
good.
split the difference there.
Right.
I appreciate the clarity.
Thanks.
Thank you.
And it sounds like Jeanette agrees that's what you were thinking too,
I do.
Jeanette? About the
Yes,
simplicity,
exactly.
yeah.
Oh,
Okay.
good, good, good. Thank
Yes,
you very
keep it
much.
simple.
Okay. So the last item on page 7 of the hard copy, number 10, talks about on page 6, the first bullet point, just the assumed rate of return and measured over what period. So again, in the IPS page 6 under investment objectives, namely return objectives, the first bullet point where it is stating what we're trying to do is earn a total rate of return net of fees that achieves at least the plan's actuarial assumed rate of return, but we do not mention a specific period. When we think about the plan itself, right, it operates in perpetuity. And somebody could be collecting benefits for, a beneficiary, could be collecting benefits for 20, 30, or hopefully longer years. So in order to meet that actuarial assumed rate of return, I think a longer period is probably better. I mean, not 30 or 40 years, but probably a little bit longer than we would normally think. So a reasonable time period I would suggest would be more in the sort of 10 to 20 year time frame.
I think I'd be good at looking at rolling 10 years.
Oh, I think that's a sound suggestion too, because that should in theory encompass a full market cycle period. So we could do a rolling 10-year
Is that
period.
okay with the board, rolling 10 years? That sounds
Yes.
good. Okay.
All right, great. So now we'll move ahead to page 8 here in the hard copy, and we'll look at number 11. And you can see on page 8, number 11 on the top, and it says page 6, second bullet point. Without getting into the granularity of the suggestion here, it's basically a grammar question, and I will probably have to defer to the board. Grammar's not my strong suit. But if you look on page 6, again, this is the bullet point below what we just looked at under return objectives, where it says the total annualized net investment return. So when we think about, again, this from a grammar perspective, it's my understanding that when you think about the subject of this sentence, it's singular, total annualized net investment return, and then you have from, which is obviously a preposition, all the investments in each asset class, but then the verb is modifying the subject. So it should be is.
Wow.
In the interest of full disclosure, I checked with my wife. I checked with my wife on that.
That was good.
I could not be more succinct. That is correct. It would have taken me 5 minutes to explain that, but
Okay.
yeah, it's all good.
All right, great. So then we're hopefully, we'll come to agreement that we can leave that one
As
alone.
is.
Leave as is.
Thank you.
Read the whole document, start over.
That's right. Pun intended, leave as is,
Two
right?
subjects there.
Now, the subject is annualized net investment return, right? And then from is a preposition. So that's a
Pardon?
dependent clause, maybe?
Well, then insert "and from each asset class." That's called parallelism.
You got me there. You got me there. And we can certainly modify that if the board wants. We can add "and" and then changes to "are."
I'll grant you one subject, a verb, in exchange for adding "from."
I'll take that trade every day. Is the board amenable?
Is that okay with the board? We'll look at that in a red line version.
Yeah.
That sounds reasonable.
All right. I thought I had it. Okay. All right. So page 8 again, number 12. So on page 8 of the hard copy, number 12, it talks about on page 7 under diversification. There's a sentence in here when it talks about, when it's clearly not prudent to do so, but it's not necessarily explained within the document. So it's open to a wide range of interpretation. And within the document itself, we want it to be clear and concise, but we also want it to be flexible to some degree. And I think in this case, rightfully so, we should err to the clear angle. And the suggestion, again, on page 8 under number 12 is to add an example, right? Severe equity bear markets, which is alluded to the correction after 9/11. Now that occurred amid a longer equity bear market. There were some pretty deep drawdowns amid the financial crisis, but long story short, I think it's reasonable to add some, or maybe just a couple examples that more clearly explain the sentence as suggested.
I'm open to examples, yeah.
Yep.
Okay.
Is that okay with the
That's-
board? We'll insert an example or two. Okay.
Okay.
Great.
All right, great. So number 13 is a little bit of a different animal here. There was just a question on page 7 of the document. And again, this is what I'm referring to is on page 8 of the book, number 13, under proxy voting. What is the current policy? So what I've done here is I've just basically copied and pasted the current policy just to answer that question. And as you read this policy, proxy voting is an interesting animal in that if you have investment managers running specific accounts at, say, Wells Fargo, right? So managers that have discretion to buy and sell individual securities at Wells Fargo, then they will receive corporate proxies here and there. And how they vote the proxies would likely be defined in the investment management agreement between the two parties, the county and the manager. Right now, there are no separately managed accounts. They're all mutual funds and commingled funds. So they obviously own equity securities, and when those proxies come up, since there's no contract between the two parties, it's governed by the individual prospectuses, mutual fund prospectuses. So they will vote those in the best interest of the shareholders as they see them, but those proxies don't come to the county. The managers vote them on behalf of the shareholders, of which the county is.
Right.
The only time you would get a proxy is when, say, a specific mutual fund issues a proxy around maybe changing the guidelines of the fund, or maybe the board of directors for the fund is up for nomination or a vote. That would be the only time you would receive a proxy and have to vote on it. So around the languages, since we don't have any separate account managers, the proxies should be coming few and far between. So the new language, which is on page 7, under proxy voting, under diversification, is fairly broad. What it's trying to be is, recognizing the fact that proxy voting is of utmost importance, and just stating that the board will vote proxies in the best interest of the plan participants, pretty much full stop.
Then let me ask my colleagues where it says, may provide general guidance to the trustees' proxy voting standards. do we ask for what their standards are and/or ask in retrospect how they voted?
Or was that to me? I'm sorry, Mr. Walters.
Anyone?
No, I think he asked the board
Oh, I'm sorry.
to think about that. Any thoughts from the board members?
Well, the current IPS requires that we get a quarterly, semi-annual, or annual report as agreed upon with each specific manager. I don't think we've ever done that, and I don't think we've ever seen any report or inquired about any proxy voting.
No.
So if I may, I think, that specific statement, the trustees, when delegating proxy voting authority, would only happen if you have a separately managed account, which you don't have right now. And if that would occur, then you can build in the proxy voting guidelines into that specific agreement with said investment manager. So it's more of a catch-all, saying, we don't have it today, but we might in the future, and if we do, then this is how we want to proceed. And as far as if that did occur, developing the specific proxy guidelines, that's something obviously we would help with, and incorporating that into any investment management agreement with the county and another party.
So I think you've preempted my question. So if we may provide general guidance, that would not necessarily require a redoing of this entire document then?
No, because it would be embedded in a separate document.
Right.
Okay, great.
Okay. Anything else on that issue? Okay.
No.
So no change, it sounds like, to the document as suggested. And now we're on page 9, number 14.
Yes, thank you, Dr. Bridget. So that one is actually on page 8, but please note that this falls under investment manager selection criteria on page 7. So I just want to make it clear, that specific suggestion, where it's falling under. So 14, page 8, it says the first bullet, so it's the first bullet up in the top, where it simply state investment management fees compared to the industry average. So again, this is something that the board would consider when determining or when selecting an investment manager. And the suggestion is just, and please correct me if I'm wrong, we would insert here investment management fees compared to peer group average as opposed to industry, which I think is perfectly reasonable, and to make that change, unless there are other comments there.
No. It's good.
Good. So now 15 under page 8, there are a number of 15, page 9, and this is on page 8 of the investment policy statement. So in the policy statement, just as quick background, there's a section on mutual fund and commingled funds, and this is really, think of it as a catch-all. Recognizing the fact that there is no direct agreement between the county and that fund itself, but the trustees, obviously with our guidance, are going to make every reasonable intention to only select managers that comply with this document, even though we can't dictate the terms. So that's really the purpose of this section itself. Now, as far as the suggestions, and we'll go back here to number 15 on page 9, as far as a couple of references here. So namely that these managers being required to have multiple managers, that's a little bit tricky. Many investment firms have different investment structures. You could have a firm that has maybe one portfolio manager and then maybe a team of 15 or 20 research analysts, right? So a pretty deep bench behind them. And you could have another firm that has 2 portfolio managers and nobody behind them. So obviously that's a pretty extreme example, but making that change to the text could actually lead us in probably a different direction that I think is the intention of the suggestion, if I'm reading it correctly. So I think that one I would I would think long and hard about that one. Again, we want this to be flexible enough that we're not constraining ourselves, but obviously thoughtful enough that we stay on the right path.
I think I was thinking at that point, I had been through a rather recent and unfortunate discussion of a presentation of a fund with only one manager and a 2-year track record. There were some other ancillary things around that recommendation that, in my mind, meant it should never have seen the light of day to the party to whom it was presented.
Sure.
So, colored by that unfortunate experience, I thought it'd be better to, just set some guidelines for, I don't want a Johnny-come-lately MBA from Harvard running a fund that was just invented last week or last month. I think anybody that was around back in the late 90s, early 2000s, there were new funds popping up every week with people who had virtually no industry experience because they had more funds than people to staff them. I don't want to go down that road again.
I think that's a point well taken.
We might quibble over the specifications here, but a
Right.
longer track record of the managers and collaboration and a longer fund life, all those things are important to me.
Sure, and I think so. Looking at the rest of page 15 here, as far as the next one saying, have the average tenure of such managers be not less than X years. Usually, for those who incorporate that in the policy, it's usually a number of 5 years. Still seems a little short, but generally I've seen it as low as 3. So I think somewhere in the 5 to 7 year range is reasonable, because if we take that into consideration with the next suggestions of having a long, at least 25-year track record, if we instituted that, I can tell you right now that we would have to turn over probably more than half of the pension fund, right? Because the managers in here right now, there's many that go back multiple market cycles, say to 05, 06, 07, but then they would not meet that criteria.
Well, I'm willing to go with 7 based on your suggested range.
That wasn't my suggested range. It was more of an illustration of what's in the fund right now. I think again, what's reasonable is a number like 5 or 7 years.
I'll go with
7, because you're just limiting the opportunity set there.
So can I ask, on page 9, at the end of that numbered 15, it says, hold these comments for possible inclusion in a proposed new appendix. What does that reference?
I think, so we'll be there shortly, Dr. Bridget. We talked about at the last meeting, having an appendix talking about specifically prohibited investments. And this could possibly be included there, but I would respectfully suggest that instead of including it there and in this section, that it be under investment manager selection criteria.
Okay.
Right? What we're really talking about here, and please correct me if I'm wrong, that we would have an average tenure of 7 years as a minimum, and the fund itself to have a minimum 7-year track record, and we would add that again to the preceding section on page 7 under investment manager selection criteria, which articulates what the board would see as a minimum requirement for consideration.
I'm good with that.
I'm okay with that.
Yeah, me too.
Pat, do you have an
Yes.
opinion?
I'm sorry?
Do you have an opinion about the 7 years?
Yeah, I think the 7 years is reasonable. I wouldn't go as much longer than that, but 7 years usually encompasses a market cycle. So, we've hopefully been able to see them, quote unquote, weather the storm and come out of the other side. And there's certainly nothing as important as actual experience of having to manage money in those types of markets. So I think 7 years is reasonable, and we won't have those issues that I outlined a minute ago around what's in the pension right now.
Okay, are other folks okay with that?
Yes.
Yeah.
Okay.
Okay.
So now we are on number 16, on page 9, and this references page 8 in the document, specifically the first bullet point under equities. And this is a pretty straightforward suggestion, just adding American Depositary Shares following American Depositary Receipts. The latter is the last item in that first bullet point in the first bullet point on page 8 there. And at the risk of getting too granular, these terms are used interchangeably, even though they're not the same thing. An American Depositary Receipt is essentially a foreign company issuing shares on a U.S. exchange. That's what's called the receipt. And the individual shares of that issuance is the American Depositary Shares. So people use them interchangeably, but they are actually not the same. So long story short, I think it's perfectly reasonable to add that.
Okay.
Okay.
Is that okay with the board?
Yes.
Okay.
Yes.
A few bullet points below that, it's the fourth bullet point in that same section, just a simple suggestion where this states that no manager will be making an investment exceeding 10% ownership of a single security, with the suggestion of lowering that to 5. I think that's perfectly reasonable. There's nothing in the fund now that's going to come anywhere close to 10 or even 5. So that wouldn't sort of hamstring or constrain us, but it's a simple, I think, straightforward, risk management type of change. So the board's
Is
amenable.
that okay?
Yes.
Change that for the board? Okay.
So the last one in that section, this is 18 on page 9 in the hard copy, and then the bullet point below that says, stock options may be utilized by an investment manager managing U.S. equities in a covered or hedging posture, but not in naked or speculative posture. So what does that mean? What does that mean? So basically, speculative posturing within options would be buying and selling option contracts without holding the underlying securities. In other words, say you sell a call option on a security. You could be on the hook to deliver that security if somebody calls that option. And if you don't have it, that means you're forced to buy it at some price. So that's very speculative. So that would be banned in this case. What it's referring to as options that are covered, it means that you already hold the security. So why would somebody do that? Say a manager holds a security, really likes the long-term outlook for the security, but maybe the short-term outlook isn't great. They might sell a call on that security. In essence, selling an option for somebody to call or take the security from them if it rises in price. Now, again, maybe the manager thinks the short-term outlook isn't great, so what they're trying to do is essentially enhance the return a little slightly, because if you sell an option, you collect a premium or you increase your income. So it's less speculative since you already own the security itself. That's why we have it permitted here. But again, if the board would want to remove anything related to stock options, which is a little bit more, esoteric than a lot of the things that we talk about, then I think that's reasonable.
So is your suggestion to now shift the stock option to a prohibited activity?
Yes.
Okay. Just wanted to be clear. Is that okay with the board for a stock option as a prohibited
with that?
activity?
Yes, that's reasonable, and none of the managers that are in the fund now are doing it.
Yeah, I'm good.
Okay.
Okay, so I think we could probably move a little bit more quickly here over the next few items. If you look under number 19, page 9, under the book itself, and then page 8 in the policy, it starts talking about private equity, private debt, and hedge funds. So a lot of the comments are around being on the books now. Obviously, they can't roll off, but we're not going to, utilize these types of investments moving forward. So based on what was approved before, this would be contradictory to the approved asset allocation. So let me just pause there for any comments around that specifically.
Well, if we acknowledge that we're basically stuck with what we've got, not really stuck, but it would not be prudent to try and get out of them. It would either be impossible or would take a real haircut, which we've gone over before. That notion of, hey, we've got these things, let them play out. And I'm fine with that, but I don't think we ought to go back into that well in the future. There's just too many downsides associated with them.
So based upon, and again, I don't mean to repeat myself, but when we did the asset allocation, we had options around avoiding that moving forward. And the board ultimately chose the latter option, which would keep them moving forward. In other words, future commitments to those asset classes would be made to
Correct.
maintain those target levels.
Correct. But nothing new. When those age out, my argument is let's not replace them with something else. Let's let them age out.
Right, so again.
Right, but it's the last page of the document, right, that you're referencing, where we have private equity is a target of 6% with a 12% maximum. Is that what you're saying? You're saying we're still staying within our targeted, so if we stop that, it affects our policy statement.
Not exactly, and I apologize if I'm not doing a good job explaining this. So say, we'll
It
just
might
talk.
be helpful, Pat, to go to the chart.
Right,
Oh, the
that's where
chart,
I
okay.
was.
No, on
I
page
think-
6 of the.
Oh,
On page 6, okay, so this
That's
is,
what the
this is the
board-
hard copy, this is the hard copy book again. Thank you, Ms. Pratt. So on page 6, what we discussed
Oh, I
in the
see.
asset allocation, again, was the straight, simple portfolio of 65-35.
Right.
And then the latter two were saying, hey, we can't get out of these today. What should the targets look like reflecting that? And assuming that there would be no future commitments, that these were just going to roll off over time, and we could adjust these targets over time as the values changed. The last suggestion all the way to the right was essentially coming from us saying that we want to reduce the alternatives from a target allocation perspective, but we do still think they make sense to hold to some degree moving forward. So, which would require not just letting things roll off, but making new allocations to them over time to maintain these targets well out into the future.
Well, we've already learned that some of these are going to take years before they mature or fully pay out, correct?
That's correct, but they pay out over time as well. So many of the investments in that arena are on the newer side. So they're in a period where they're calling money from investors, not returning it. What we'll see in the next 2, 3, 4 years is that a material amount of that money will start to be returned back to the fund. And in order to maintain a target close to what was approved, then eventually, maybe in a year or 2 years, we'll need to consider a new commitment to a new fund that will then be calling money to maintain that target based on what was approved in July.
Okay, so I think that's a very clear statement, but it also kind of makes my point that I'm all for honoring the obligations we're involved with now, but I am not supportive of getting into new private equity or private debt once all of the current obligations have been satisfied. That means money called away, as we agreed, and then the life cycle of the investment coming to its end, and we've collected our money back. It seems to me that there's a time value of money, and it's not fully appreciated when we go into a private investment.
Well, I think it depends how you, I wouldn't call it time value of money. I'd call it whether you're being compensated for the risk that you're taking. And maybe we're talking two sides of the same coin here. But when you make those allocations, and again, many of you who are on the OPEB committee have seen the positive implications of these asset classes, is that if you can select a good manager within those spaces, that over time, investors have been compensated via higher returns than the public equity markets, for taking that illiquidity risk. So that is sort of that's the trade-off, right? And over time, whether it be private equity relative to public equity or private debt relative to public debt, investors have been compensated to the tune of 3 or 4 percentage points of a premium relative to those public investments, compensated for that illiquidity, namely that you don't control the cash flows and the money is locked up over time.
Right, and so if we take Mr. Walter's suggestion, it would be contra the plan that was approved in July.
That's my understanding.
Okay.
Yes. Yeah.
Okay.
Right.
Yeah, but I thought what we had approved was based on what we had and was not really discussing bringing new things on board. Or maybe I misunderstood that vote.
I would defer to the other members of the board of what their understanding was at the time.
I viewed it as moving forward as strategic, as it implied. I mean, that's how I viewed it at the time.
Well, it's only a comment on my part. I mean, I'm not the determinate factor here. But my comment is, we stay with what we got. We have funds committed but haven't been called away yet. And when all that clears the books years from now, we can either then, under some future board, take a look at it. But my preference is near term, let's not go there again. Let's just deal with what we have.
And so what I just said is I don't think this is appropriate in this document because it's contraindicated for what's currently the strategic
policy.
asset allocation. So they seem contradictory. So unless that's resolved and we change the strategic asset allocation, then it wouldn't be appropriate to go in this document, because they would be opposite one another. Would the board agree with that for now? We can certainly revisit it at another time.
Yeah.
Yes.
Okay. Okay.
Yeah, revisit.
Okay. And like I mentioned earlier, the strategic asset allocation side is strategic asset allocation exercise, something that we'll do on an annual or every other year basis. So to the extent that things change, then the document will be updated and the strategy will be updated as appropriate. So that would be page 19, 20, and 21 on page 9 of the book. That would also cover 22 and 23 on page 10. There was a similar suggestions around the public versus the private. So the next key item would be on page number 10, number 24, and then page 11 of the document itself, the IPS. So number 24 on page 10 specifically states on bullet point 2 to limit 10% to 2 references of where is now 25%, and then a quick comment about zero coupon treasuries. So in the document on page 11, this is referencing the middle bullet point where you see the 3 bullet points towards the top of the page. This is around guidelines around fixed income. You'll see the first number in parentheticals all the way to the right of that second line, basically stating that fixed income's limited to 25% of any given manager for any individual treasury investment. So that sounds pretty high. So when you see the 25% there and then later on talking about federal agencies, it's higher because those securities are backed by the full faith and credit of the U.S. government, obviously being treasury bonds, being federal agencies. So that's why those numbers are higher. You know, I don't think we would come anywhere close to that. If the board would be more comfortable lowering those to 10 is the suggestion, or perhaps closer to 15, I think that's a reasonable change to consider.
Well, unless I'm misreading the paragraph, it's any single issue. It's not treasury bonds in general. It's any single issue.
So the sentence itself there is there's no limit upon treasury securities except that any single issue. So the except is modifying treasury securities.
Right, but but let's say they come out with an issue next month of 30-year bonds.
Right.
That would be the issue to which the current 25% number would apply, correct? Has nothing to do with 30-year bonds. It would be
Right.
that issue,
Correct.
which I think is too high a percentage for an issue.
I mean, I think, 25% is somewhat standard, but if the board's not comfortable with that and would like to lower it, I think that's reasonable and wouldn't have a big impact.
And so your suggestion was 10, Pat said 10 or 15. Do you stick to your 10?
I'll
Very
stick
good.
with 10.
Okay.
Okay.
Are board members comfortable with 10?
Yeah.
Yeah.
Okay.
And then just quickly on the zero coupon issue, zero coupon treasuries are basically treasuries that pay no interest. Hence zero coupon, no coupon payments. And why managers use them are basically to manage duration or the interest rate risk of their funds. So they typically don't do that with corporate bonds or mortgage-backed securities. They use treasuries because they're the most liquid market in the world. So, that would be the reason for somebody owning a zero coupon bond, would namely to be to manage the interest rate risk within the portfolio.
But not to provide us any current income stream.
No, that would be zero. Right.
That's why I don't think we need them.
Well, I think it's now that you see, if you move that 25 to 10, the 10 is for zero coupon as well. I mean, we could lower the number. I wouldn't take out that section completely because then you have no constraint, right? So if we wanted to lower 10 from 5 there, that could kind of split the difference.
Okay.
Is the board okay with that?
Yeah.
I think, can you repeat that? I'm sorry. So you're going to lower the 10 to 5?
Yes, this is specifically for the zero coupon issues, which is in the beginning of the fourth line in that second bullet point
Yeah.
where you see
Okay.
10 and then parentheticals.
Okay.
Yeah.
Okay, so moving on to, we can do 25 and 26 on page 10 in conjunction. That is in the middle of page 11, the 3 sub-bullet points you see there around cash. So the middle bullet point talks about FDI insured deposit accounts. And the suggestion is just to note the limit or the amount of the coverage. So the amount of the coverage for banking institutions cash deposits is $250,000. So we can simply state that as well. And the below that, that's talking about is specifically sort of money market funds held at brokerage accounts. So we have one of those because we have cash at Morgan Stanley right now. That's not covered by the FDIC. It's covered by what's called SIPC there. That's a nonprofit organization basically doing the same thing. And the coverage limit there is $250,000 like the FDIC. So we can add those numbers if the board would like.
Okay.
I
Is the
put
board
the
okay?
word currently in front of the dollar
Yeah,
amount
that's good. That's a good idea.
because those things do change.
They do.
Is the board members okay with that? Yeah.
All right. So on 27 on page 10, we'll talk more about this shortly, about prohibited investments. On page 28, on page 10, this would be page 12 of the document itself. So you can just see at the top of page 12 there, we talk about reviewing investment performance. So we, investment consultant right now, Marquette, report on a quarterly basis the performance of the trust. The comment on page 10 is referencing a quarterly basis, not necessarily that we would prefer less interaction, but just when we report performance, which we only do on a quarterly basis, right, when we do the performance reports. Although some of you may be happy to hear that once we get this long-term strategic plan in place, that you may not see me every month, maybe every other month. But all kidding aside, so that's what that's related to. And then finally, 29 there, just modifying a couple of words, inserting the word to in a couple of places, which is perfectly good with me, not being the grammar expert.
Great.
I do have a couple comments on
Yes.
that. So early on, when Marquette came on and you joined us, We had an initial conversation about developing the policy statement, and one of the things that I spoke about liking in a current one is that we have our watch list and these procedures for it. What I noticed was missing from this one, and the reason why I like the watch list is because it sets the criteria for why they would be on it and what the consequence would be, and then, all the actions that follow. So the thing that gives me concern about the draft copy is that we say that they'll be compared quarterly to the peer universe benchmarks. I don't know what that necessarily means. I trust it actually means something. And market indices for the equity and fixed income, I know what that means. But what are the qualifiers? So is it going to be 1 quarter, 2 quarters of negative performance compared to their universe benchmarks? And what would be the consequence? So how do we know that?
Sure. So that's my mistake, Lieutenant. We have language around that, and if it would be okay with the board and yourself, I can add it.
I mean, I think in my time here, we've had a couple occasions where that did happen, and then it rectified itself, and they came off the watch list, but...
Right, so it's very subjective, right? I mean, you try to clearly delineate and define what would, make you put someone on the watch list, but it's easy to put somebody on the watch list. It's more difficult to take them off, right? And I can say right now that performance is usually never a good reason to fire someone, because performance is very cyclical. Sometimes managers are in favor, other times they're not in favor, but over the full market cycle, you would expect an active manager to outperform.
But if they're on the watch list, they're being measured against their peer group, right? So the whole peer group is probably going to be out of favor.
That's correct. So I think we just have to be careful about what the parameters are to put somebody on the watch list and take them off, but also be very careful about parameters of what constitutes a reason for terminating a manager.
Well,
yeah, so like
which
the
I think
current
is-
watch list gives criteria like, so 2 out of 3 quarters or 2 consecutive quarters. So I would be open to, expanding that length of time to capture more of a market cycle or whatever, recognizing that a market cycle is not 2 or 3 quarters, but a longer duration of time. And then especially, much to Mr. Walters' point in the discussion we had about managers and their tenure and the length of the fund that's been in existence would, if they have any substantial or any substantive changes to the plan itself. So if they change managers on us and we're not aware, the plan would require you to tell us.
No, absolutely.
Or
That's
style drift.
Right.
Yes.
So I think we have language around that. We'll add it to the
Thank you.
document. And
So the board's supportive of adding some watch list language into the document?
Yes. And apparently universe was already in this one. So if they fell below the 50th percentile of their universe, so it's all relative, obviously, then, so.
But, I don't know if you all know the answer. Do you know to what or how closely those parameters were followed in the past?
They reported on them. We had a couple people on the naughty list.
I remember a couple going on and one that did get off.
Yes.
In
Okay.
my time on the board.
And the good thing was it immediately withheld us from contributing anything additional to them. I mean,
Right.
I don't know if this is still feasible in the current version or something like that, but.
Well, we'll take a look at that in our own internal language and cook up something for your review.
And I think that last point is the most important one, that if they're on there, we're not going to pump more funds to
Right.
them.
Right.
Okay.
And then I just had one other question about the document itself. Page 4 under responsibilities, and then specifically responsibility of the trustees as well as responsibility of the investment consultant. It calls for you, it would say you would review the IPS on a regular basis and recommend modifications. For us, we shall examine the IPS periodically and monitor implementation. I'm the kind of person that would like to put a timeline on it, so if it's 5 years, 6 years, 7 years, so that we have this, we go through this exercise every so many years.
Concur.
more clearly define what that timeline
Do you
looks
have
like.
a
I'm open-
recommendation?
I wrote down 7, 5, or 6, knowing that for the drop, we put a 7-year sunset in there for review, and we periodically RFPs, so 7 years, I'll throw that out there, but
Well, I think that's too long. I think we ought to look at the document no less than every 3. It's just a, quick look.
Right.
Are we still happy with the language we adopted 3 years ago? Doesn't mean we have to change it.
Any other suggestions or thoughts from the board members of a 3-year or 7-year window?
Well, how about a 5-year in the middle?
Right in the middle is 5 years, is
Go with the
Jeanette's
middle.
suggestion. You go with the middle? Yeah, 5 years is good with me. We'll do 5.
that's all I have. Thank you.
Perhaps say something like at least, in case there's an occasion
At
to
least.
visit it before.
I'm sorry, I missed your first part.
Hamstrung. Say something like at least 5 years, so if you revisited it before the 5 years, you're not hamstrung.
Right.
You're still okay.
Yeah, it's a good idea.
Yeah.
Okay. Any more questions or comments around the body of the document before we wrap up here?
Oh, and I'm sorry.
Oh,
Might have missed it. I was gone for a couple meetings. The current one, does it not have the strategic allocation table? And we talked about that early on as well. And are we going to do that as an appendix to the IPS?
yeah, you're scooping me, Lieutenant.
It's
Catherine
next.
paid me extra.
Yes.
When we saw the bill you're going to give us for the last month. All right, good deal.
So this would be the attachment of the document itself. So one of the reasons, Lieutenant, that we include it as an attachment is, like we rightfully talked about a second ago, the languages in the document doesn't change all that often, but the asset allocation does. So as opposed to making it more complex, just kind of swapping out attachments. So this is page 14, the last one. So, and this is also referenced on page 11, but again, I'd sort of respectfully submit that
I see it.
the targets here on page 14 are what were approved at the July meeting. So any sort of modifications would really be around the ranges themselves, where you see minimum and maximum. And the key thought process around those is everything with a target north of 10% is really plus or minus 10% for the min and the max. And then anything with a target of less than 10 is either 0 or double the target, to try to maintain some, level of consistency around those respective ranges themselves. So again, I think this also is a little bit more clear than the existing document, because there are a couple of tables that were quite different, where here it's pretty explicit about the asset class, the target, and the respective benchmark of how we're going to measure success.
So just based on your formula, is there a reason that the tips and the cash is 2% and then goes to 5% instead of 4%? I mean, if you're doubling them, I mean, I know it's,
It's more of a nice round number in that case, but
Okay.
you got me there.
I mean, for me, it's easy if it's consistent.
But we
And
can make those changes, because I don't see it in a situation where we're breaching it for tips. For cash, depending on flows, we could get close to that, but we shouldn't be upwards of the 5. But I think the 4 is reasonable, and happy to make that change.
Well, without discussing the percentage, why isn't tips under fixed income?
Well, it is fixed income, obviously, as you rightly know, but based on, again, the role that we wanted to play in the portfolio of inflation protection, it is listed with those other assets themselves, things like real estate, things like infrastructure, right? That insurance or that protection that we'll need if inflation picks up more materially than it has in the past. That's why it's located under that section.
Well, why would private equity not fall under equity and private debt fall under fixed income?
Because I think,
I know they're different beasts, but
Right.
generically,
Right. And
isn't equity equity?
technically, equity is equity. I would say that, a couple things. Number one, it's certainly more of the industry standard to segment it like this. Number two, the benchmarks are going to be very, very different. between all the two of them of equity, debt versus debt. Now, this is a little bit more nuanced, admittedly so. We have equities, private markets, hedge funds, real assets, fixed income. To your point, if the board wanted to make it more simplistic, then we can make equities, and list private equity there, saddle private debt under fixed income as well, move tips as well. But I think how we think about this and how we handle the education was not just, what asset class is what, but what do we want it for? What is the role? What do we want it to do? And this is how that's delineated.
I'm not sold.
Well, I guess I'll leave it to the other board members to get other feedback around it before I keep talking.
My preference would be that it's segregated in a way that it's compared to the appropriate benchmark that informs us the most. I appreciate Mr. Walters' point and, the distinction of differences, but I'd rather it be, for this construct, it would be important to have it compared to a benchmark that makes the most sense for us to
But we
educate
can still
us.
do that by moving it up into a different category.
That's not, what I was hearing was that it would then be compared to a different benchmark.
Well, they would still each use their own respective benchmarks, but the other issue around that is that related to the private markets, there's a lag not just on the reported values, but on the reported benchmarks as well. So if we wanted to report a total equity number and include private equity, we couldn't do that until 5 or 6 months after the fact.
Yeah, but you're doing the same thing right now with domestic equity. Benchmark is the Russell 3000, okay? International developed MSCI. So they're tracking their own individual benchmarks, even though they're both huddled under equities.
Correct. But again, with the private markets, those benchmarks are reported on a daily basis. Private benchmarks aren't reported until, again, 4, 5, 6 months after the fact. So if we wanted to think about it as a whole instead of the individual pieces, then that would present a problem in the performance reporting calculations because we couldn't do total equities until 6 months later.
Can you tell us why the low side on equities is as much as 20% off of our target?
The low side on equities, I'm
Yeah,
afraid I
minimum
don't follow.
percentage equities, 45%. And yet we're trying to huddle plus or minus 65.
It's plus or minus 55, sir.
Oh, target is
Right.
55. So then, did we not have somewhere else that we were going with a 60% allocation? Saw that in another document.
No, sir. On page 6 of the previous document, if you look at the U.S. equity and total non-U.S. equity on a cumulative basis, that's a 55% target. So that would be the second darker line to the right on page 6, and then the third darker line to 34, 21, 55.
You in your hard copy now?
Yes, sir. On page 6.
So the way I'm reading this, the asset class, top of that column, we're looking at a 65-35 allocation. Just depends on what you drop in for those numbers.
I'm afraid I don't follow, sir.
Page 6,
Right.
okay, asset class where it's shaded, come across, 65-35.
That, so again, the column all the way to the right is the approved asset allocation, so ignore everything to the left. What you see boxed up there is what was approved in July, and is what is reflected on page 14 of the investment policy statement.
35 and 21. And I'm getting all confused, but it looks to me like we're running down two different tracks here with our numbers and what we want to do.
How so?
Well, if it's the column to the right, so we have U.S. equities, 35, and then we put in developed large cap, 14, 7. That's 21 on top of 35.
It's on top of 34. Sir.
On top of 34, okay. That's 55. Where's the other? Oh, I see what you're saying. So not really running on a 65% target. for
Right.
equities.
Right, because that was not what was approved in the July meeting. So this is a summation of what was approved as illustrated on page 6.
Aha. Must have slept in through that vote.
Any more questions about that? Okay. So if we could move on to page 12, excuse me. So to your question earlier, Dr. Bridget, around prohibited investments. This was a suggestion, I think we spoke about at the last meeting, maybe making it into an attachment as opposed to a brief paragraph, which again, I think is perfectly reasonable. But I do want to just talk about a couple of things that should be, I think, quickly discussed. So if we work our way up and down the page here, number 1, direct trading in foreign currencies, I think that's absolutely worthwhile to prohibit. That's a very speculative way to invest, to say the least. Number 2 would not be included, or would not be a prohibitable investment based on our earlier discussions. Number 3 is a little bit tricky. Says securities which are not listed on a U.S. exchange or approved for sale in the U.S. So it's somewhat semantics, but obviously we hold international equity mutual funds, emerging market equity mutual funds. It is bought and sold in the U.S., but the underlying securities are non-U.S. securities. So again, you could argue it's semantics. I'd argue that unless we hired a non-U.S. equity separate account manager, which we would not recommend because it's usually painful to set up things for your custodian to buy those securities on international exchanges and so on and so forth, very, very costly, that given the semantics around the mutual fund, that I'd recommend not including that in prohibited
How
investment.
about we modify that to say, no direct investment? So if we had an emerging market fund, that's where they're going to go to get their holdings, right?
Right, and that's why I brought the point up.
All right, so no direct investment on anything not on a U.S. exchange.
Yeah, we can approve that. I mean, the chances of that actually happen are nil, but not non-existent. So we can change that to direct if that would be amenable to the board.
Is that okay with the board? Yeah, it's fine.
Okay. The next few, 4, 5, 6, and 7, I think are pretty straightforward here. Direct investments, kind of like what Mr. Walters were talking about a second ago in cannabis-related companies, real estate, commodities, options, and futures. I think that's all reasonable to prohibit based on our previous discussions. Number 8, non-marketable securities. So we would not include that because the private investments are non-marketable. Margin transactions, again, very, very speculative, perfectly reasonable to include that. Securities denominated in a non-US currency. So we're back to our conversation from a second ago to some degree, right? Because the mutual funds you hold are denominated in US dollars, but the underlying securities are denominated in other currencies. So I would actually think, and interested in your feedback, that if we change the direct above, then this would essentially accomplish what number 10 is getting at.
All right.
You think that's
I'm okay.
consistent? Okay. 11 cryptocurrencies, 100% agree. Index tracking funds that contain any performance enhancements. These are generally called enhanced index funds, as it was laid out here. We typically are not a big believer or recommendant of that, so we're happy to include them in the prohibited investments. And then the latter four here, 13, 14, and 15, we already talked about making these changes in the investment manager selection criteria section, so that'll be covered there as opposed to the prohibited investments. And then finally, 16, the contractual agreement with an advisory firm. I believe, somebody correct me if I'm wrong, that would be the investment consultant. I don't think you need that in a prohibited investments. That would really be covered in, say, an RFP, where you can basically constrain the list of respondents of having X amount of years, X amount of experience, so on and so forth. And then with all that said, on page 13, again, we talked about at the last meeting, just including basically a glossary of various definitions. So we would look to include that as well moving forward. So it's, as we wrap up this discussion, and just very, very quickly here on next steps, on the next tab here. For the next meeting, we'll have that asset value update and any recommendations as appropriate. We will have this red line IPS document based on the discussions we had today. As far as custody RFP updates, we've been working on the draft of that RFP. Internally, we hope, and Ms. Pratson, correct me if I'm wrong here, hopefully that'll be posted by the end of October, I believe?
Yeah,
Okay.
that's the goal.
So that's moving ahead there. And then later this year, in November, obviously, we'll have the Q3 performance report to round out the year, in addition to updates on everything we're covering. So I know that was a little long. We've been here for a while, but any other questions or comments from the board around any of the discussion today?
Anything else from the board? Thank you very much. It was very thorough, but we needed to go through it, so much appreciated.
Absolutely.
Great. Thank you, Pat. And next, we move to committee reports, the administrator's report. Sheila?
Yes.
And welcome. I think this is your first board meeting with us, so welcome to
Thank you.
SORP. You're welcome.
We received 2 invoices, one for a Bolton retirement calculation for $270, and the second invoice was from Marquette Associates for the April 1st through June 30th, 2021 investment consulting services for $30,112 for a total of $30,370.12.
Thank you. Are there any questions for the administrator on the administrator's report? Hearing none? Sorry.
That was an expensive plan policy statement. It was 3 months to defend Pat. $30,000.
If there are no questions, we need a motion to approve the administrator's report.
I'll make
So
a motion
moved.
to approve it.
We have a motion. You have a second?
Second.
Any discussion? Hearing none. All those in favor?
Aye.
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 Any opposed? Motion carries. Thank you.
Did we
Thanks,
talk
Pat.
about the last time you showing us what our custodial charges are?
In the report?
Yeah.
Yes. So when we do the third quarter report in November, remember we showed the investment manager expenses. We're going to show hours, right? Even though Ms. Smith just read them off, we'll show hours, and then the
Okay.
custodian, so
I
you
thought
have
we
a
did.
full
All right.
take on all the fees. Yes, that will be in there.
I also had intended to include it on the administrator report whenever we pay the quarterly fee.
We talked about that as well, I
Right,
think.
but
so
that
was
wasn't
good.
appropriate. I mean, we haven't paid it yet, so.
Thank you. Item 5 is public comments. It doesn't look like we have any public comments. So with that, we will entertain a motion to adjourn.
So moved.
Second.
We have a motion to adjourn in a second. All those in favor?
Aye.
Any opposed?
Aye.
Motion carries. Thank you all very much.